Candlestick chart patterns are something you've probably come across. There is plenty of content on YouTube about them, but few actually explain how to really understand them. Without a proper understanding of them, it simply means you are just ignorantly copying patterns, and it won't make you profitable over time. Anyways, my name is Z, and I've been trading Forex for about 4 years now. And one thing I realized when I started trading is that many trading concepts are explained in a very complicated way, which makes it harder for beginners to truly understand the market. So my goal is to break down complex trading terms and strategies into simple, easy-to-understand explanations, like I wish someone had taught me when I first started trading. So by the end of the video, you'll know exactly how to properly use chart patterns. This is not financial advice, it's just for educational purposes. So without much talk, let's get started. A chart pattern is a price action formation created by the movement of price on the chart repeatedly. Chart patterns help us to understand the market behavior from the past, so when you see the pattern present itself in the future, you can predict what is likely going to happen next. The outcome of a chart pattern can be different depending on whether the market is active and volatile or calm, and whether the trend is upward or downward. Before we go any further, you need to understand that there are two types of traders: the patient trader and the impatient trader. The patient trader enters a trade with a limit order. A limit order is an instruction to buy or sell at a specified price. This means the order will only be executed if the market reaches the price you've set. Limit orders are patient buyers or sellers. They're not in a rush, they just wait for the price to hit their desired level. But on the other hand, the impatient trader enters a trade with a market order. A market order is an order to buy or sell immediately at the current price in the market. Market orders are impatient buyers or sellers. They want to buy or sell right now, no matter the price. They don't care if the price is too high or too low, they just want it now. So price movement happens when the impatient traders overpower the patient traders. This happens when there are more market orders than limit orders. One more thing I'd like you to understand is stop loss. Stop loss is an order also, whether you agree with me or not. When you set your TP and SL, it literally means you're placing two orders in the market. One is for when the market goes your way, and the other one is for when the market goes against you. For instance, if you long Euro USD and it goes against you, your stop loss is going to sell and kick you out of the market. This is called forced execution because this isn't what you want, but you have no other choice. So with that in mind, let's talk about chart patterns. Number 1 is the flag pattern. A flag pattern is a chart formation that looks like a flag on a pole. It forms after a strong price movement, followed by a ranging market that creates a small channel that slants either up, down, or sideways. A flag pattern is usually a price continuation pattern. Knowing that it's a continuation pattern doesn't really explain why it forms on the chart. When you see a descending flag pattern on the chart, the market is actually looking for enough sellers to reverse the market trend. And the same thing goes for the ascending flag pattern. After a strong downtrend, when you start seeing the market ranging in a slant form, the market is looking for enough buyers to reverse the market to the opposite direction. When the buyers the market is looking for can't reverse the trend, you will see that the candles start getting smaller and smaller. At this point, the sellers have seen that buyers are probably sleeping on the opportunity the market is presenting to them, so they gain confidence again, jump into the market, and continue with the trend. Remember that the market presented an opportunity to the buyers, so some buyers did enter the trade, just that it wasn't enough to reverse the market. So since the trend is going to continue, their stop loss is going to get a painful blow, which will further push the price even lower. On the flip side, when a descending flag pattern fails to see enough sellers to reverse the market, the buyers will quickly swing into action and continue the trend. The few sellers who participated in the market will get stopped out and even contribute to pushing the price higher. This is one of the reasons I had to do the basic explanation of how stop loss is also an order to avoid any misunderstanding as we go forward.
Anyways, when the trend continues and breaks above the range for a descending flag pattern, what you want to see is a strong break with a candle body, not the wick. When it breaks with a fat, juicy body, you know that the price is actually ready to continue. But if it closes with a wick, it means that sellers are rejecting higher prices. You may want to try taking a nap or something. Just do anything other than taking a trade. But what if the flag breaks downward? Sometimes the flag breaks downward instead of upward. This could simply mean that lots of sellers participated in the opportunity that the market presented, and the trend might likely change. The second pattern is the rectangle pattern. The rectangle pattern is an indecision pattern. A rectangle pattern happens when the price moves up and down in a range. The top level is resistance, where sellers are active, preventing the price from going higher. And the bottom level is called support, where buyers are active, preventing the price from going lower. When the price bounces back and forth between these levels, it means that buyers and sellers are in balance. Neither buyers nor sellers are dominating. A range of market doesn't last forever. At some point, the price will break either to the downside or the upside. When the price breaks out of the rectangle pattern, the balance of buyers and sellers is disrupted. The market is no longer in equilibrium. Equilibrium means equal, by the way. When the breakout happens, it often means that the market has shifted and a new trend is about to start. This is why traders often jump in during breakouts, expecting the price to keep moving in the new direction.
After the breakout, the price doesn't always come back for a retest, but when it does, the risk-to-reward ratio is always good. Many traders get nervous at this point, wondering if the breakout is failing, but in fact, a strong retest is a good sign because it confirms that the old resistance has now turned into support. For the downward breakout, the old support has become a resistance. Traders who are still selling at the resistance with their stop loss placed above the resistance will get stopped when the market breaks out of the resistance and moves higher. These traders are forced to buy, which will add even more fuel to the price movement, driving the price even higher. This is why a strong retest often dishes out a good risk-to-reward ratio. But if the price breaks out, mostly with a wick, and then quickly snaps back inside the range, it simply shows that the breakout wasn't real and the price is reversing back into the range. The traders who entered the market after the breakout expecting the price to go higher now have stop losses placed below the breakout level. When the price snaps back, these stops get triggered, adding more selling pressure and fueling the reversal. The third pattern is the head and shoulders pattern. The head and shoulders pattern is a reversal pattern, and it is one of the oldest. The head and shoulders pattern consists of three shapes. It has the left shoulder, then the neck, and then the right shoulder. The head and shoulders pattern also has support, which is mostly known as the neckline. The left shoulder means that the uptrend is still valid and making new highs. The head means that the buyers push even higher to form a new high. Then the right shoulder means that the market tries to break structure again and form a new high, but it can't reach the previous high, that is the head. This means the buyers are getting weak and can't maintain the trend. The neckline we talked about earlier is the support level, and when the price breaks the support level and closes below it with a candle body, not just a wick, it means that support is gone, and sellers might swing into action. The same thing goes for the inverted head and shoulders. The neckline is the support, and when price breaks it with a candle body, the market might likely start a bullish trend. What if the head and shoulders patterns fail? Sometimes price might break the neckline and move back up, even going above the right shoulder. If that happens, the head and shoulders pattern has failed and means that buyers refused lower prices, and traders who predicted a downtrend will get stopped out, and their stop-loss order will help fuel the price to go up even further. This also applies to the inverted head and shoulders. Like I have been saying, the simplest way to spot this fake breakout is through the wick and the body of the candle. If the price breaks with wick, it is simply a rejection, meaning that the price is rejecting the breakout and only broke out with a wick to catch liquidity. But when the breakout happens with a fat, juicy body candle, the breakout might actually play out.
The fourth pattern is the double top and double bottom. A double top pattern is a reversal pattern. When the price reaches a high and then pulls back, it goes back to the same high again and pulls back. Buyers tried to break a level twice, but they couldn't. The double bottom pattern is just the opposite of the double top. Price drops to a low, then bounces from there. It tries for the second time and still bounces.
If price finds it difficult to break past a level, it means that there is some form of resistance stopping it from moving forward. For the double top, sellers are the resistance that acts like a wall, which prevents the price from going up and breaking new highs, while the double bottom has buyers positioned as a wall resisting the sellers from breaking new lows. A double top is likely to reverse the price when it breaks the neckline, and a double bottom is likely to reverse when the price breaks the neckline. This double top and bottom pattern is best to trade when the price comes to retest the neckline. That is the way I trade the double top and bottom pattern when the opportunity presents itself. A double top and bottom is likely to fail, so how will you know? When the price breaks below the neckline but then quickly goes back to the neckline and then breaks the two tops, it simply means that the pattern has failed. The same goes for the double bottom. When the price breaks the neckline and quickly goes back to the neckline and goes ahead to break the two bottoms, it means that the pattern has failed. A failed double top can have a strong move because the stop loss of all the traders who thought that the price would reverse has been triggered, causing a huge push upward. And the same goes for a double bottom. I beg to differ, but this fifth chart pattern is by far the healthiest, simplest, and less chaotic chart pattern out there. And whenever you see it in the chart, it plays out 80% of the time. The chart pattern is the ascending and descending staircase. This is a trendy chart pattern. Every other pattern we talked about here is either a continuation, a range, or a reversal. The ascending staircase forms in an uptrend, where the price keeps making higher highs and lower lows. You know, when we talk about support and resistance, most traders think it only applies to a ranging market. Support and resistance work perfectly in a trendy market. It is called dynamic support and resistance. When the price moves upward and creates a high, the price pulls back a little to create a higher low. So the higher low is the support, and the high, or the higher high as the case may be, becomes the resistance. So this means that since it is a bullish market, buyers are positioned at the support and sell off once the price breaks the resistance. They rinse and repeat this pattern until the market reverses. When this pattern fails, it is usually not hard to spot, because that is when you see the double top and bottom, the head and shoulders pattern in your chart, or the market suddenly enters a range. Though sometimes price will just reverse without showing any of this pattern, usually because of news, market emotions, and whatnot. This type of reversal is strong because it wasn't anticipated, like when you see a chart pattern and start anticipating a reversal. This unexpected reversal takes out millions of traders from the market and uses their SL as fuel to reverse massively. Okay, that's it for this video. Drop me a like, drop your comments, and please subscribe to my channel, and I'll catch you on my next.